Welcome back to F.A.C.E, Lakshman. Great to have you here, and all of this, conflicting economic situation that we're in, and Fed leaking articles in the Wall Street Journal. So welcome back, Lakshman. How have you been?
Well, I've been well, and thanks for having me. Good morning to everyone. Yeah, certainly. Yeah, every day there's some, new unexpected development.
Have you ever heard? Have you ever heard the word unprecedented being used so frequently? Isn't it unprecedented how frequently unprecedented it's used nowadays?
Yep. I mean, I'm always reminded of there's the old Chinese curse. May you live in interesting times.
Okay.
And
Yes.
we certainly have that.
Yeah. So if you'd like to share your the screen, I know.
Oh, yeah, sure. If you guys are up for, I got some charts for you if you want.
Yeah. So it's at the bottom, and
All right.
when you guys were tweeting promoting the interview, I said we were looking forward to seeing you because you give us clarity. You always bring that to the table. So I'm as confused as everyone else is with all these conflicting economic signals. So glad to have you here.
Sure.
Let it roll.
Tell me. Well, yeah, no, I'm happy to be here. Happy to take questions.
Okay.
Tell me if you can see a slide that says
Got it.
cycle risk is investment risk.
Got it.
You got it. Okay, great.
Yeah.
And Dale, if there's a particular thing you or the team wants to cover, let me know. This deck talks about cycles in the economy, how they link up with different market prices, kind of laying some market prices over some of the economic cycles. Then it wraps up by talking about inflation cycles, the Fed, and is this current downturn over? Do we see the end in sight yet, or do we have to be a little more patient?
Okay.
And that takes about 10 minutes to run through.
Yeah, go ahead.
All right.
I'm patient enough for
All right.
10 minutes.
If you guys, 10 minutes is too long, let me know. Let me know. Just to set the table, again, for those who may not know me, I don't know, some of you may already know me, but I'm standing on the shoulders of some giants of cycle research. So it's 3 generations of research. Wesley Mitchell, about 100 years ago, helped defined what a business cycle is, and that's the same thing we talk about today. And then Jeffrey Moore, who was his protege, was the father of leading indicators and started to forecast turning points in business cycles and growth rate cycles that we're going to talk about today. We're covering about 22 economies. We've been doing international economies for decades. And so basically the stuff I'm talking about here, it works, and we've tried to break it. Okay. And it's not a model, but it's a framework for looking at a free market oriented economy. And that's the requirement, that the economy we're talking about, the US, China, Europe, or whatever, that it's dominated by free market activity. It doesn't mean that there's not intervention. I mean, because obviously there is, but that it's still dominated by free market activity. So this did not work. We tried it in the former USSR. It did not work. Okay. We tried it in, we also were trying it in India before the economy was liberalized in the early 90s, and it didn't work. And that's good in a way, because it shouldn't work in a command economy.
Gotcha.
But so we've done like some testing about where it breaks. Basically, I'm interested in this because I think these turning points, when trends break and go the other way, I think that's like the toughest thing to figure out. Everybody's headed one way, but it's going to break and go the other way, and that's a really interesting moment because it diverges from the consensus view at that moment, and becomes very valuable.
It's
And we
also
have,
where the big money is, Lakshman.
yeah,
I
if you
got
can,
like,
yeah, you said it. I agree with you 100%. Right?
all the Paul Tudor Jones, so it's not me either. I mean, trading legend like him says all the big money is made at the turns, quote
Yeah,
unquote.
I remember, I think it was in Market Wizards, but I it I may have read it elsewhere where, he might have a thesis of a turning point ahead, right? He's not
Yeah,
sure because he trusts, he honors the market,
right.
and he'll take pot shots at it.
Yeah,
He won't put on his big
plunge.
trades until after those pot shots are really working, and then he'll start to
Smart.
load up. And it was a fascinating, I think it's a really interesting way to approach this information.
Right.
And
You send out probes,
yeah, you send out
right?
probes, and he
Yeah.
was a client, so we had a good
Oh,
time.
okay.
Yeah.
Yeah. All right.
So look, there's nothing's perfect. We're not perfect, but our record of forecasting turning points is unrivaled. I don't know anyone who does it as well as we do. And so basically, this stuff we're doing is obviously important around cycles. People become more interested in it when the R word, shows up on the newspaper or on the tape.
Yeah.
But even away from recessions, accelerations and decelerations in growth are really important. The Fed misreads those and gets in trouble. And I think the antecedents of what's going on today is actually their misreading of what was happening before COVID. It set them up. It kind of got them flat-footed and all twisted in knots, and now they're kind of chasing their
Well, they're
tail.
the opposite of you. They're
Yeah,
looking at lagging economic indicators while you're looking at
precisely.
leading
Yeah,
economic.
and that doesn't work if something's cyclical and you're reacting to it in a way, in a kind of a engineering sense, you're going to make the cycle bigger, not smaller.
Why? Why? I mean,
Yeah, it's a
they can
good.
afford the best research on the planet or bring in the
Yeah.
best research. It to me, it almost sounds like you know, not a
Oh,
mistake, that it's
no.
intentional.
Well, yeah.
I know it sounds like a
I don't think they're
conspiracy.
organized. I don't know that they're organized enough to have it fully intentional, but I think there's a lot of economic kind of ivory tower dogma that gets wrapped up in there. They
Okay.
have 400 some odd PhDs. So they have
They
a
were
lot of,
all at Goldman.
yeah. Well, there may be some revolving door stuff, and not maybe, there is revolving door stuff. That's the crony capitalism, which we don't like. Um,
Okay.
but when we get to the theory, our observation is it's around the 50s or 60s or 70s. You have the economic profession really get enamored with they just had physics envy. They wanted economics, which is not a hard science, to have the stature of the hard sciences, mathematics and
Yeah.
physics and medicine and all this stuff. And it doesn't. It's not. It doesn't work that way, right? Because we have all our wetware, we have all our greed and fear in there, in the economics in a free market oriented economy. And when you've got that psychology kicking things around,
Yeah.
it's not something that you
It's not
model
pure.
that well. Yeah,
Yeah.
it just
It's
doesn't
not
work
pure.
that way. And
Yeah.
still they want it to work that way, so they build
So
bigger
they
and
could
bigger
get paid
models.
like the others.
And they build bigger and bigger models, and they have scenarios, and models have a purpose. It's a useful tool to have in the toolbox. It is not going to tell you the risk of a turning point ahead. That it will not do. It just doesn't do that well. It's like using a hammer for a screw. It won't work. And this is the if you're interested in the risk of a directional change in growth and inflation, what I'm showing you, I think, is the state of the art. I don't know of anything better.
Well,
So
I think that Tom Brady thinks that models have purpose. He
Mm,
married a supermodel.
I'm not going to disregard all models,
Oh,
okay? And they certainly have a purpose.
all right.
But what I'm going to say, though, and this is maybe I'm playing with words a little bit here, which is fun to do, but rather than having a model, we do have a framework. We have a cyclical framework. So it's an organized way of looking at the world. And so here, I just want to get down to like, what are we talking about? So we're talking about cycles and growth. And it's not exact. I think it's pretty. Not everybody would think that this chart is pretty, but I think it's pretty. It's a line of a coincident index growth rate. The coincident index includes the things that Wesley Moore helped identify 100 years ago to define the economic cycle. And it's very straightforward. It's how the output, how much stuff do we make, employment, how many people are working who are in the working population, how much are you earning, not you individually, but the nation, the nation's economy, and how much are you selling? What's the value of what you're selling? And these things are all related. None of them are discrete from one another, right? And it's the reason why, for example, you can't just look at GDP and say, oh, if I see 2 down quarters, it's a recession. And if I don't see 2 down quarters, it's not a recession. Because a recession is the co-movement of those 4 indicators: output, employment, income, and sales, going negative. That's a recession. Or, and I think this is important for market prices, forget about recession. I would just say, for right now, recession is just a bad downturn. Just the acceleration and deceleration in those indicators as a group. And so the shaded areas here are marking off decelerations in those 4 indicators. And it's messy. They don't all move at the same time. It just doesn't work that way. The world is not that simple. It's much more complex. But we can, to my eye, and when we look statistically, we can see upswings, cyclical upswings, and cyclical downswings. So the shaded areas marked off by this blue line, this growth rate, are times when there is a pronounced, pervasive, and persistent acceleration, the white areas, or deceleration, the shaded areas, in those coincident data. And our contention for this morning, let's say, is that that's really important for risk on, risk off. That's the basic backdrop within which I know when I was walking in, the gentleman was talking about some shorter term trading positions. You could totally have all kinds of gyrations within an upswing and a downswing, and one does not preclude the other. This is telling you, is the wind at your back or is the wind at your face? On a cyclical basis, which looks out a few quarters. I'm not talking about years or decades. I'm talking about a few quarters, time frame wise. So that's the information that we're bringing to the table. And the blue line, just to get to today, you see 2022 on the right hand side of the chart, and what you see is that it's still positive. And I can tell you, and you probably have inferred this, that of output, employment, income, and sales, it's employment which is holding that indicator from going negative. And so if there's going to be a recession, and we believe there is, employment is going to have to go negative at some point. That will have to happen. So now,
despite, even though part of the reason for the employment picture is the Great Resignation, demographics, structural, the employment picture is more about structural rather than there just aren't enough workers in the workforce anymore.
Absolutely. There's a lot of I would say it's a little easier to point to with some of the supply chain stuff, where you can see that we're still in the backwash of kind of the COVID volatility there. But I think there's still some of that happening in jobs too. I mean, I suspect it's a little harder to like draw a straight line. But to the Great Resignation and people taking time getting back to work for a whole bunch of reasons that may end up being a little more structural, That's all in there. Nevertheless, okay, if there's going to be a recession, and we think there is, we will need to see jobs actually go negative, despite even those structural things. And so that is part of the expectation. But before we get to the recession likelihood, which we think is likely, just again setting the table that during cycle downturns, so these shaded areas are the slowdowns in the coincident index, those are dangerous times in terms of these corrections. You tend to see double-digit corrections in S&P associated
I'd
with
like to
the
I'd like to validate.
yeah.
When was the first time we talked? Do you remember, Lakshman?
Oh, I think it's going
Has
on a
it been
couple of years. Yeah.
Okay, well, at least a year.
Yeah.
And your work was saying the market's going lower. So, you know, on that turn that you saw, you know, ahead of a lot of people, many people, you were warning to be out of the market because of your work. So it's not like you're just coming to the table now
Oh
and
no,
saying
no,
this
no.
is what happened.
Yeah, I've been running
I
this.
want to
I've been doing this
validate
now.
it.
I've been doing it 30 years. I got
Yeah,
receipts.
yeah, yeah.
So
You
I got the
you weren't
receipts.
you weren't long snap during this shaded
No, but
shaded area here.
I want to also acknowledge, right? Because if you're doing shorter term trading, and I think some of the people on the call are, you've
Yeah,
got to navigate these things. That's a rip your face off moment,
yeah,
right?
bear market. Yeah,
Right. So these are so I guess here Powell comes out and he says something nice, and the
yeah,
market's like, okay, you're pivoting, and
yeah,
we're soft landings baked, and blah blah blah, and you get a pretty heavy duty rally. So this, I think, can happen. We may be in a version of it now,
yeah.
and
Because he was very mean.
yeah.
He was very mean at the last Fed meeting. Do you think he's not going to be as mean to us
I think he's
next
gonna.
week?
I think he's still gonna be mean. I'm afraid. We still got tough love.
All right,
I'm afraid we still got tough love, and we can get to that.
all
But
right.
the basic contention is wind is at your face, a little more defensive, and I know it's a bit of an. It's like it's an oxymoron, but I don't know. You know, the challenge is trading the bear market rally in a risk off kind of general posture,
Yeah,
and how to do that, and God bless you for doing it, because it's hard. I don't think that's easy to do.
yeah,
Here you go. I'm flipping from broad market to, you know, one of your bellwethers. In this case, it's iPhones, and just making the point that here's a discretionary consumer product, a game changer, right? This is like a structural change kind of product. And you can
yes,
see on the left-hand chart, there's the penetration into the market. Boom, it's just a moonshot.
right.
Okay. I think it's around early, I mean, it's 2012's in there that you get about half of the people have some sort of smartphone. So you've got some penetration now in the market. And if you switch from the levels to the growth rates, and you line them up against these shaded areas, growth rate cycle downturns, we see that here's something, and you know that this is very product cycle driven stuff. But we're seeing, to my eye again, and we can get into nitpicking on this, but we're seeing, I think, more cyclical behavior where the wind is at their back on the upswing and in their face on the downswing. You see?
Mhm.
And wherever the products are coming out, they're having to deal with that. Okay. So I think right now, I mean, this is a more anecdotal, but right, they've come out with some new products. I'm not sure of the dirty details of Apple. I don't look at them that closely, but you know, they're doing that introduction and that product stuff into a very clear downturn where discretionary spending growth is under pressure. Okay, that's the basic thesis. And here, switching from the consumer to a business, I'm picking on Google as a bellwether for ad growth. and showing, to the degree that these are lining up. And I think that is happening. So ad growth would be, advertising revenue growth would be a somewhat discretionary item for a business. Now, a business is
Right.
coming under pressure. They're trying to manage their costs. These discretionary items are the first things to go, or to come under
I
pressure.
just want to bring up the structural part of employment, Lakshman, is that it was such a struggle for business to find employees, still is, that
Still is.
that what they're going to do is cut hours
Oh yeah.
before they let them go. How does that play into your
First off, I think a well-managed company, right?
yeah,
Especially if they're, even more so if they're service oriented, is going to really protect their employees. I mean manufacturing too. You because it's very expensive to hire and fire.
yeah.
That is extremely expensive to do. The cost of letting someone go is high, and the cost of training someone up and getting them into your culture and so on and so forth. So
So
they're
it
kind of
makes me
team
think
player.
that since the Fed is looking at that, that it's going to take overkill
It
because of
is. It
these
is.
conditions.
It even goes. So now your original, you're early on in the call. You were making the comment about employment in the current cycle, and with the lack of people in the workforce and so on and so forth. Now, to your point, nominal numbers look pretty good. It's the real numbers. That's how when you look at the economy, you're actually looking at real numbers, real GDP, real earnings, real sales. So inflation adjusted numbers. But when inflation is running hot, your nominal numbers can look pretty darn good.
Yeah.
And if you're in the C-suite, you got these decent nominal numbers, and you're like, let's do more of that. That looks pretty good. I got double-digit growth in my revenue on the nominal side. Let me just keep going. And when you look at the 1970s, there's a couple of recessions there where you see, interesting, kind of unusual activity of jobs vis-a-vis recession. So in the 73-75 recession, the recession begins in 73, but jobs don't go negative for 8 months. In the 1980 recession, jobs don't go negative until a couple of months after the recession starts. So there is this disconnect between the willingness or the need or the perceived need to fire employees, let them go, and the reality of where you are in the business cycle. And I just can't resist. I was thinking of this gentleman, and I'm not sure how he's doing today, because this was back in the 1990s, and I've lost touch with him. He was a major distributor for, like, a regional distributor for Caterpillar, and running a big business, and it's a cyclical business, because that's a heavy, that's a big ticket item
Yes.
to buy, and there is discretion in that, and if you're tight, you're going to repair rather than buy new, and so on and so forth. And he was saying how he was using our cycle work, and the main benefit, right? I mean, obviously he wanted to do well in business and this and that, but his main benefit was how he was able to take care of his employees, because by being proactive in managing the business, he really minimized the need to fire people at a recession. And he felt that was one of his major accomplishments as a business person. I mean, and I really take that to heart, what he was doing.
Yeah, a business person with a heart.
Yeah.
Yeah.
I mean, he's still running a good business in this and that,
Yeah.
but you know, he's also, you know, they're working as a family, as a team. So here, I might have shown this before. Cryptocurrency is not immune to cycles. It's risk on, risk off as well. And
Do you define them as commodities, Lakshman?
not not as
What are
much.
they?
No.
What are they?
No, I mean, I might define something like semiconductors as commodities, right?
Okay.
But here, you know, it's hard to say. There was look, this could be crypto can be a game changer in terms of global finances over, you know, the system of global finance over a longer period of time.
Okay.
When I look at it now, I do see, again, maybe I just see cycles everywhere because this is what I do, but it looks like risk on, risk off to me.
Yeah.
And you know, I'm certainly open to the idea that this is part of a sustained kind of technological change in the system.
Okay.
But as a market price, I do see there's some cyclical moments for it.
So I want to ask you this because, you know, we're coming to, you know, even though we could go over that on this chart,
Yep.
and just like the first chart you showed, that we're getting near the end of the shaded area. Does that
Oh
mean
yeah.
anything? Does that mean
No,
anything?
no. This just means that I don't know what's happening. So
Okay.
this is not an upturn yet. Let me get to this is quality spread. So it's uh higher quality, the spread between higher quality and lower quality
Debt.
investment. Yeah, investment.
Yeah, I wanted to ask you that. Why, I asked the Fed guy, why is junk holding up better than sovereigns? This is part of the quality spread, right? Like HYG compared to treasuries.
Right.
They have held up better. Any reason for that, that people trust probably the private sector more than the public sector? Could that be it?
Yeah, I think there's a degree of that. I mean, if you're getting near double digit yields in some cases on that stuff and you can lock it in for 5 years, close your eyes, you know,
Yeah.
maybe that's what you do. And the political kind of implications for national budgets, you could see the volatility there,
Oh
right?
yeah. The UK.
And so we just went through it with the UK. Japan is doing, you know, they're trying to hang on to the long
Yeah.
end, and they've got the yen at, I don't know what it's doing this morning, but it's like at 150 is crazy.
Yeah.
And here in the US, you know, that you have to wonder about the budget
Yeah.
and what's going to happen there, the fiscal side of things. And so these bond market vigilantes are back.
Oh,
They're trying to, you know,
yeah.
they're kind of
They're on
they went to sleep.
steroids.
They went to sleep for a while and now they're back. And so here we are. But still the spread between the qualities, okay, is
Yeah.
cyclical. And here's a short leading index. It hasn't turned up. Now let's go to the short leading index in context. First, it's the long leader. Okay, I have a little bit, 2 months of it getting a little less negative, but this is down in double digit negative growth. Okay, I just want to put that in perspective. It is quite recessionary. Here's the Great Recession back here, right here.
Right.
So where it got to here is where it was before Lehman. This big jerk down here, that's only after something breaks. As far as we know, nothing has broken yet, I guess. You know, I say that kind of hesitantly.
Yeah, because we don't know.
But if something breaks, this can jerk down, right? So
Right.
we see how that can happen. But without that, in any event, this is already recessionary.
Yeah.
Here's the shorter leading weekly leading index down. Here's the short leading index down. And so this is why it's giving you a sense of why we do think this is going to go negative. That's broad economy. I don't have an upturn call yet. Okay.
Okay.
And without an upturn call, the prospect of the market turning up is
It's
reasonably
weak.
low.
Yeah.
The market will turn up before the economy bottoms. It's about a 3 to 5 month. It's a fairly stable lead at troughs. So if we see the economic cycle bottoming, that is a very important moment for switching from risk off to risk on. But we don't have it yet.
How far off in your gut from, and I know you don't know until you see it. Do you have a feeling?
Yeah,
Could
I
this
think it's
last a year or two?
it feels like a couple quarters, and I'll tell you why. I'm gonna go forward to the last chart, which is the reason why. This is just a PMI chart. This is
Okay.
PMIs were out yesterday. They got weaker. I didn't update this yet, but it's a little weaker down here.
Yeah.
This is a leading indicator of PMIs, is straight down.
Yeah.
Here's home prices. So here's an angle into your negative wealth effect. This
Yeah.
is real home prices,
Mhm.
which is 85% existing, about 15% new home prices. And you see the real come down in home price inflation. Now it's going negative. So levels of home prices are starting to fall.
Right.
And you see that's quite a significant decline. Obvious why, right?
Yeah.
Confidence and rates and so on and so forth. But again, here's what it looks like around the housing bust into '07.
Right.
So
Okay.
I think this is a target of the
Worse.
Fed. This is a
Yeah.
target of the Fed, right? Because the Fed was using, when they got down to zero interest rates during QE last decade, right?
Yeah.
So when they're down there, what do you do to stimulate the economy? The way to do it
Yeah.
is this kind of fourth mandate, which is the market, which is really, anything investable, which includes stocks and homes. And
Yeah.
that did stimulate. You had a positive wealth effect to
Yeah.
stimulate the economy. Here we are, they're tightening. They need a negative wealth effect, and boy, are they getting it. And I don't think they understand the extent to which they're getting this. Okay.
Mhm.
Here's the future inflation gauge. The Fed doesn't really understand cycles, and I can get into this, or just email Melinda at businesscycle.com, and she'll give you a half-hour video explaining my assertion that the Fed does not understand economic cycles.
Oh, what a nice offer.
They forgot
Okay.
what's going on, and you guys can do that, because I don't want to. I want to get to the punchline here, but basically, here's a huge upturn in the future inflation gauge, which informs us that the rise in inflation is not transitory, it's cyclical. So it's persistent, pronounced, and pervasive. And the Fed totally misses that, so they're playing catch up. They do have headline coming off, but core is sticky for
Yeah.
rents and wages
Yeah.
and things and
Yeah.
services. So it's sticky, it's up there. They're going to wait until they see this coming down before they can pivot.
Right.
Um,
Backwards.
this future inflation gauge has turned down. Okay. So the peak is behind us. We've peaked. The earlier downturn got truncated. This is Ukraine. That's the whole supply chain muck up with Ukraine. But it didn't change this direction, and it's resuming it down. So I say I'm very convinced the peak's in from a cyclical point of view. The problem is that this decline that we're seeing from off of the top, that's 1/5 of the rise.
Right.
And so therefore, if the Fed's sitting there staring at the core or the trailing core or whatever they're looking at, it's going to take a while. And if they're also looking at unemployment at 3.5%, it's in their bones that they can't pivot when it's down that low. It's very hard for them to do that.
Do we get
As a
into a period? Do we get into a period of solvency issues with corporations that borrowed money cheap? That's going to have to roll that debt over with interest rates 3-4 times higher than prior.
Yeah, they're gonna squeeze. They're gonna make everybody pay. That's
Yeah.
part of this demand destruction. That's part of this negative wealth effect that is the intent, right? So that
Right.
pain is intended. They're not
It's
like,
not an
oh, sorry, I
accident.
didn't mean not to hurt you. They
Yeah.
want to hurt you. That's
Yeah.
part of the game, because they are trying to get over the mistake of letting this go up. Okay.
Well,
And
I'll tell you what, you know what it sounds like? Revenge trading.
it kind of is. And now
You
here's
know,
the part, Dale, I want to answer your question. Like, or is the end near? Can we start thinking about it? And so in my gut, I'm saying I don't think so. And the
yeah,
reason is the top stuff is ECRI. This is where ECRI lives. This
yeah,
is long leading indicators for the world. So it's the
yeah,
US,
yeah,
it's all of Europe, it's all of Asia, and it includes India and
yeah.
China and Russia and all this stuff.
How
Okay.
ugly.
So basically, this kind of reading here is as bad as it was at
In
the depths of
COVID.
COVID.
Yeah,
It's as bad as it was right before Lehman. Here's
yeah,
Lehman as the last leg down. There's right before
right.
Lehman. It's
Yeah.
much worse than it was in the '01
.com. Yeah,
recession, the dot-com one, right? So I just want to give you a sense of what's happening. Now, typically, what I would expect, even from a central bank that is behind the curve, okay, is that when the forward data comes down to these recessionary readings, that they stop hiking.
yeah,
And that they pivot and they cut. So this is world central bank diffusion rates. So this is how many central banks around the world are raising rates.
right,
Now, basically, they all follow the Fed. They have to,
right,
largely, because they all miss the inflation upturn, but then they also have to do it to defend their currencies.
right,
So you've got, typically, if the Fed turns, everybody else can turn and ease up. And that's the counter cyclical, even if it's late. And in this case, it was late. It's still late here when they pivot, but it is not at odds with the earlier recession forecast. So
right.
here we have a recession global. That's the highest reading in history of how pervasive central banks tightening is around the world.
Wow. See
So
what I mean? Unprecedented.
so when you come back and you say, hey, Locke, are we near the end? Now, I can't predict the predictors. If the leading indicators take off tomorrow, I'm going to go with them. But
Still
that
looks ugly.
looks like the wrong recipe to me.
Yeah,
And that's where I would say, okay, trade the bear market rallies, but are we off to a sustained, pronounced, pervasive, and persistent recovery and risk on? Not yet.
okay. Let's wrap it on.
Okay.
Let's wrap it on really and a great session, great stuff. If you can read what people are saying, Lakshman, people are
Yeah.
grateful for the presentation.
Yeah,
And
I'm happy for the time with you guys, and if you have any questions, shoot them over to Melinda, just Melinda at businesscycle.com. And if you want the inflation presentation, what the Fed doesn't get about what the Fed forgot about inflation cycles, just shoot her an email and she'll get it to you, with a link to you. It's just a link.
thanks for being a watchman for us,
All right.
Lakshman. Really appreciate it, buddy.
All right. You guys have a good day.
All right, Lakshman Achuthan with us today, and I told you he'd bring some clarity to it. And thank you again.
Thanks a lot.
All right, guys, you could join the team in 4 minutes on the Morning Edge. Don't just count your pips, count your blessings. Definitely was one having Lakshman with us today. You're welcome, everyone. See you tomorrow. Don't just count your pips, count your blessings. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.